So let's get into what we're going to cover during this session. And essentially what I want to do is cover just these few things here. The first one is we've just had an election. I'll do a little bite-sized thing just on the election and what's happening in the economy. Obviously, some pretty interesting things right now. And we'll flow from there straight into looking at the property market, what's happening in the property market. Then we're going to probably look at what's likely to happen. We look at specifically interest rates, which I think is on everybody's minds at the moment. I can see the share market has tanked again this morning. I know, thousands of dollars have come off my super fund shares in the last, certainly the last month in particular, but that's a lovely roller coaster, and how it will impact property. And then we'll also look at buy, sell or hold. That's the final thing is, well, what should I do right now? If I own property, should I be keeping it? If I don't have property, should I really be doing that? Should I put more money into my business? What should I do? And that's probably the perfect segue before we talk about the actual economic environment and what's happening, the facts and all the data of what's happening in the market, is just wanted to point out to people about business. We have a lot of business owners that invest in property. And one of the key things for us all to realise is that a lot of people invest in their business and they keep throwing their money into their business. And what we always use is we try to talk about the term of diversity. Just like in life, you need a balanced life. Having all of your money and all of your financial upside all tied up to your business can be very, very dangerous. What you really want to do is make sure that your business, or whether yourself personally or your business, that you do own some real estate of some description, and any other forms of assets, could be intellectual property, all sorts of other business types of assets that you can have, but you need some real value that's independent from your business itself, or you're really operating at high risk. Now, yes, high risk, high reward, and a lot of business owners love their business. I know I love my business, Ironfish, but I can tell you, I still don't put all of my money into this business. I need to build things outside of that as well. So that's probably just a little bit of a mindset tip as we head through this when talking about the property market. And we all know everyone loves property. We're in a country called Australia, and let's face it, there's quite a bit of property here, but there's also a very interesting environment. Now, we just had an election. And really interesting election, obviously, the teal wave. It does feel like the election landscape could have fundamentally changed during this last election. And we know that, and I see that for definitely as a big, big positive in terms of I suppose the end of some of the status quos and things that are happening in the past, particularly things like the boys' club, if you like. Now, these are the major sort of issues. I know there's a lot of things you could talk about election, but as a snapshot, we don't talk about cost of living. It's about inflation. It's around the economy. It's obviously people's wages rising, all of those sorts of things. There's lots of cost pressures in the economy, and that cost of living or inflation is really important. Now, there are lots of positives when it comes to owning property in an inflationary environment, as opposed to some other asset classes. But look, we obviously need the economy is going to be really important, and in a way, this was probably a bit of a poison chalice election to win, would be my comment, because things are going to be a little bit tougher over the next 2 or 3 years, and so pretty much whoever won was probably going to face pretty similar things. Both parties actually had, or major parties certainly had, not too differing a lot of the economic policies. There were some differences, but not a hell of a lot of difference. Climate change is going to be a huge thing over the next decade. And then, of course, the one thing the change of government has meant is the possibility for a reset of the relationship with China, and that's quite important economically. So we can see that all state economies, and in COVID, I'm almost using the words post-COVID now, but we're still kind of in COVID. We're not quite out of it, but we're all definitely living with COVID. And you can see in this graph here that all of the economies, actually all of them except the ACT, as you can see here, that's the second one from the right. That was the only one that didn't actually go into a negative sort of economic position during this period. But what we've seen here now is everything is now back in the black. All right. So we've got this sort of thing, and this is demonstrated, it flows directly through to unemployment. Obviously, we've got a situation here where nationally that we've got an unemployment rate now of 3.9%, less than 4%, and it looks like it's heading south. It's the lowest level since 1974. And you can see a lot of those percentages here, incredibly low in New South Wales, ridiculously low in WA. And we can see South Australia, Queensland really heading south, and look, they're fantastic tight markets. And that flows through the job vacancies. What it means when we've got a low unemployment rate is it means we're starting to see there's more jobs than there are people going for them. And certainly it's qualified people for those jobs, which is important, which is one of the reasons why a lot of the different visas and working visas and migrant visas and stuff are very important. You can see here on each of these, New South Wales, Victoria, Queensland, South Australia, WA. You can see before, which is the blue on the very left-hand bar, that was February 20, just before before COVID. And then, of course, it was a big setback, and then it's obviously each of these have climbed up to very, very strong positions. So really strong increase in job opportunities. There is a labour shortage here in Australia, and this is one of the things that's hugely important as we open our borders and those migrant numbers just continue to, surge back to almost pre-COVID levels pretty quickly. Now, when we talk at any property market, we look at a couple of fundamentals, particularly supply and demand. Very, very nice and simple way of looking at a market. Now, on the demand side, one of the ways we measure that is we look at loans. New finance that's happening in the market is one way of measuring that. And we've got owner-occupiers, and we're going to look at investors. So owner-occupiers first. As you can see here, it's a bit like, there's this huge surge. We're coming off record highs in terms of the numbers of home loans that were taken out by owner-occupiers. If you have a look at this, everyone surged to pretty much a new high across every state. However, what we've seen is New South Wales and Victoria in particular have pulled back a bit. We expect it to pull back a little bit further. It's not going to go through the floor, but it is going to pull back. Interest rates, whenever interest rates rise, it's always that the reason why they raise rates is to try to dampen demand, to try to slow things down, because the economy is kind of running away. And so that's obviously something that we expect to move back. There's less of a drawback from the other states, Queensland, South Australia and WA. And if I can mention one thing, I know there's quite a lot of people from Sydney on here tonight, but I'm sure or today, I'm sure there's other people as well. But, don't just think when we're looking at investment and looking at the market that you're only looking at the market that you live in. All right. It's only sometimes during a property cycle that your particular market will be the right one, not just the familiar one. So it's something just to mention. Now, on the demand side as well, Labor got in. One of the things that they've done, which is going to increase demand, was something aimed at home ownership. The first home owners called shared equity, a shared equity scheme, or what they termed help to buy. So without going through, you can Google this later because I don't want to spend too much time on the details of this, but essentially people can get into a property with a 2% deposit, and it will be sort of income indexed. So obviously it's for people earning moderate incomes, $90,000 to $120,000. And there's about 10,000 positions available. And essentially what it does is the government will contribute, for example, 30% of the purchase price for an existing home and 40% of the purchase price for a new home. So what it actually does, you don't have to pay any rent or interest to the government, but essentially it would bring the size of a home loan down substantially. For example, in Sydney, it might reduce a home loan from $950,000 down by $380,000. Now, it also means that they own that portion of equity at the other end, but in terms of getting people into the market, in terms of an affordability measure, it's definitely will be driving some demand. Now, let's have a look at investors. Same thing here. We're coming off record highs across all of the states, with the exception of Western Australia still hasn't reached a record high yet, but all the other markets, they did. And yes, there's been a bit of a pullback, but it's not as much of a pullback as there was for owner-occupiers. And the owner-occupier market was the thing that really boomed, I suppose, during this last 2 or 3 year period, particularly off the back of home builder. But what we're looking at here is $11.7 billion of investor commitments in March 22. So we're looking at big numbers. Now, investors' numbers are surging and they're continuing to rise. So whilst we think owner-occupiers will continue to reduce until they reach a more moderate level, what you're going to find is investor numbers are going to continue to increase. And what's really interesting, though, is who are these investors that are out there buying and why are they buying? So have a look at this. Really interesting stat came out from Matusik about 2 months ago. And what they looked at is for the 12 months through to January 2022, of all the investor buyers, nearly, 9 out of every 10, nearly 19 out of every 20 of investors that bought, they weren't first-time investors, they were existing investors, second or subsequent investors. So what that tells us is investors who've got experience and who own other properties are very actively getting into the market again, whereas other investors who haven't invested before, so want to be investors, they are less active. Now, this is one of those things. If people that are experienced are really active at something, and the new people tend to be a little bit intimidated with something, you've really got to make sure that you're following the right crowd, all right? Because as interest rates rise, there'll definitely be people going, oh, geez, property, got to stay out of it. You really need to look at the data a little bit more than that. I've just bought another property about a month ago. I'm going to buy another one. I've got another one slated for the last quarter of this year. I'm continuing to buy. And what I know is most experienced investors are pretty active in the market, particularly because we know that the rents are rising big time. And that means even if rates go up, you're going to find that your income will go up as well. Now, on the the supply side, we've looked at the demand side. And we've got very strong sort of demand in terms of looking at it financially. And I'll talk about new migrants coming and obviously population growth in a second. On the supply side, when we look at listings, what we're seeing is that we're still, as you can see there on the screen there, the blue line at the bottom, we are still way under the 5-year average. In fact, we're 28% under the 5-year average for the number of listings for this sort of time of year. Excuse me. Now, new listings definitely have been increasing a little bit. So what's happening there is definitely the sales volumes are going down. So we anticipate this could go up a little bit. But the point is that there isn't this huge supply. And probably with interest rates, even if they go up a little bit, none of the commentators I'm seeing is there's going to be a surge of new supply on the market because most people will hold on if they can. There's not going to be a lot of forced sales. Now, apart from the existing properties that are available in the market, this is the real pressure point. What about new property? So for a growing population, and we do have a growing population now, I'll show you the stats in a second. What about, are we supplying enough properties for those people? Well, the reality is that there's been a 35% drop, a decline in the dwelling approvals over the past 12 months. Now, that's really, 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 really huge. And one of the reasons for that is not only obviously the environment that we're in at the moment, but is also inflation is hitting construction costs as well. And with all these increases, lots of new houses, townhouses and apartment projects are no longer viable anyway. So even just because something's approved doesn't mean it's going to go through to being actually delivered. So we're actually seeing what we believe is going to be a substantial drop, even further drop and the amount of new supply coming onto the market. And this is a real problem. This is a real problem in the market. If you look at apartments, for example, CoreLogic reported, look at this, Charterket Kramer's forecast for Brisbane, Sydney and Melbourne predict that this year's 28,000 build-to-sell apartment completions, so 28,000 new apartments in Melbourne, Brisbane and Sydney completed this year, they reckon within 2 years, by 2024, it's going to more than halve to only 11,000, from nearly 30,000 to just over 11,000. Now, so what they're saying is, as demand seems to be going up, and certainly as migration, we open the borders, the supply is going down. Now, where are all these people going to live? So how's this playing out? Have a little look at a snapshot here of the different cities, the major ones, Adelaide, Brisbane, Gold Coast, Melbourne, Perth, Sydney. I've highlighted Melbourne and Sydney there a little bit because they're the ones with a little minus sign, a negative in front of them in terms of monthly growth, which has definitely turned negative a little bit in Melbourne and Sydney. But one of the things we've got to be really careful of here, everyone, is don't believe the media hype just per se at everything. There's not normally one property market, even in one city, let alone everything. You'll find different parts of the market will behave differently, and certainly different price points within the market will behave differently. But definitely, without a doubt, Melbourne and Sydney markets are pulling back a little bit. They're all sort of slowing down a little bit. But what we've also got to realise is that growth is not consistent. And when we have a look at this, it's really interesting to look at the different sectors of the market. So if you have a look in this graph here, what we've got here is we've got Sydney, it's got on the left, then Melbourne, Brisbane, Adelaide and Perth. And what we can see here is that the most expensive properties, if you like, That's the dark sort of purple or blue on the right-hand side of each of these things. They're the worst performing in each of the markets. So what that tells us, for example, in Sydney and Melbourne, is that it's the highest priced sector that's pulling back, that's leading the charge. And that's obviously impacting overall. There is still and when it comes to very active, still growing markets like Brisbane, Adelaide, and Perth, we can still see strong growth, but it's stronger is in more affordable property sectors. So what does this tell us? What it tells us is that the affordable end of the market is outperforming. And so that really leads us to ask a question around capital growth. Yes, there's been some really good capital growth. Well, what's going to happen now? And will property keep growing? What will drive the next wave of capital growth? And this is a pretty scary sort of situation for many people, because a lot of people, and the markets generally do respond well to fear, well in a sense if they have a reaction to it, is what's going to drive this next wave of capital growth is going to be affordability. And so not surprisingly, those top ends of the markets, or certainly the middle markets where people have upgraded their mortgage, gone from a $1 to $1.5 million mortgage or whatever because of the low rates, that part of the market definitely is going to pull back. But sub-$1 million market, affordable property around Australia, we still see strong demand, and there's going to be good competition from first home buyers, investors, and all sorts of things. So, and into this market, there's very little affordable new product coming. There's very low supply. And at the same time, we've got this growing population and strong rental growth. So one of the things that's really going to get investors and entice them back into the market, why they're so active, is because there's a bit of a perfect storm at the moment. And if you are a renter out there, I'm afraid you're going to have it's not going to be a great time over the next year or two, because your rents are going to go up pretty much universally across the country. And it's a very terrible situation, particularly at the lower socioeconomic part of the market. It's some really terrible stories coming out. You can't help but have empathy for people that are having to move completely out of areas and they can't even afford it, away from family and friends. So for disadvantaged sectors of the market, everyone's going to feel the pain, but some people literally are going to feel it more than others. Now, that's obviously not great. There is, however, on the other side of the coin, there is a perfect opportunity for landlords. In fact, landlords are needed. Investors are needed in the market to help provide more properties, because rents are going up. And you can see here from the strong growth in the past 12 months, this is to May 22. So stats, absolute latest stats. You can see there across the board, the least was 5.1% and the most was 12.8%. But you're looking for all apartments universally, apart from Perth, you're looking at 8 to 10%. And then we're looking at, obviously, over here in terms of houses, it sort of ranges from 5 to 12%. But what we are seeing now, particularly in Sydney and Melbourne, is we're seeing apartment rents increases now outpacing house rents. So it's pretty interesting. And the reason for that is that the same thing, supply and demand, the number of total properties listed for rent nationally are 26.5% less than they were a year ago. All right, so this is, again, there's less properties for rent. Properties are coming up further. And one of the things that's leading to is, of course, the vacancy rate. You can see how much we're in an extraordinary market here. And at the same time, the only way to stop this massive inflation with rents is for more supply in the market. And that supply is very, very difficult to come by. So look at the vacancy rates. So the vacancy rate is out of 100% of the time. What percentage of time statistically would there be the number of properties that might be vacant during a particular time? And look at this. We say that a market balance point is about 3%. And look at these figures. Anything less than 2% normally means there's pressure on rents rising. Anything sub 1% means there's extreme pressure. Look at these here. Adelaide, this actually is not correct. The vacancy rate in Adelaide, I think I've moved this around. Actually, the 1.6% is Melbourne, and is Sydney, and the 1.9% is Melbourne. My apologies for this slide. It must have been an error when I was incorporating it. So what you've got is incredibly low vacancy rates. That's these ones here. Gold Coast, Perth, Adelaide, and Brisbane are all these sub sub 1%, and the other two here are sub 2%. So we've got extreme pressure here on terms of the vacancy rates, and that's leading directly through to houses and unit rents. So, so just a really shocking situation here when it comes to the availability of rental properties. And at the same time, Australia's about to boom with new migrants. Now, we know that Australia is a wonderful destination. I mean, people love the idea of coming to Australia. But look at this. Where are these people going to live? We've got all these people, and we know that when people move to a new country, they rent to start with. It's going to put even more pressure on the rental system. And as we can see here, we saw the impact of COVID here. Instead of sort of 200,000 plus migrants for the previous 10 years, all of a sudden, close the borders. Of course, we're into the negatives, but this is financial years. So starting July the 1st, in about 2 weeks, over the next 12 months, we've got 180,000 new people coming to Australia. Where on earth are these people going to live? We need to supply new properties, and there just isn't really enough. And at the same time, we've got interest rates, and they're going to impact the market. What's going to happen? Well, I wanted to show you in a single slide what's going to happen with interest rates, because there's a lot of articles and a lot of confusion out there. But basically, we think that interest rates, they're going to go back to about 5%. The only question is how long it's going to take us to get there. Now, obviously, they went 0.5%. They went whack last week. There's probably most likely going to be another 0.5%. What they're wanting to do is to put a handbrake. They want to slow down the economy a little bit, and that's why they're going to do this. But there's also, it's only providing consumer sentiment permits. So there'll be a point where if they move too quickly and there's going to be a negative reaction, then they're going to have to stop. My hunch is that it's going to be something around about what we're looking at here, Westpac in the middle. They're going to move quite quickly. The actual rate that we're going to end up paying, so your typical actual mortgage rate, we're assuming it's 2% on top of the cash rate, I reckon it's going to get to about 4% by around the middle of next year. I reckon Westpac have got this about right. Now, these are incredibly cheap rates. Even at 5%, investing works really well. But the difference if you're an investor and an owner-occupier is an investor, every dollar of interest is tax deductible. So you've got less of an impact. Plus, you've got increasing rents. If you're an owner-occupier, every dollar of interest is not tax deductible and there's no assistance. So this is all the more reason why you need to make sure that you've got properties outside of your home, and obviously you've got some assets outside of your business. So will there be mortgage stress in the market? Overall, the view is that there probably won't be. There's record savings rates during this period of time, people paying off additional money while they could. Most households are ahead on their repayments. Any new borrowers in the past year or two, obviously there's a 3% buffer rate by the banks. They're assuming someone was going to have that rate to a 5% or 6% anyway. And we've got wages are rising. Are they rising fast enough? We'll see, but they're definitely rising. So should I buy, sell or hold? Well, as I mentioned before, I mentioned the word diversity at the very start. You've got your business, and then you need to have some assets, something outside of your business. And what we really believe in, and this has certainly absolutely changed my life in the past 20 years, is around this idea of accumulating a portfolio of properties, minimum 4, we say, holding on to them, and then you get to enjoy the benefits of those over a period of time. Now, we don't know how long it's going to take for a property to double in value, but what we want to do is make sure we get the right properties, that they're easy to hold, and easy cash flow wise. And I'm going to give some cash flow tips for investors just at the end of this presentation. And then what we want to do is make sure that we can hold on to them for a longer period of time. So people who are investing only because interest rates were 2 or 3%, and then they're selling them now, these people were never going to become financially independent, never. They clearly do not understand what it is because those rates were unreasonably low. All right. It's a bit like I'm only going to buy bananas if they're 10 cents a kilo. You buy them 10 cents and then they go up to the normal banana price. And then, of course, you're not eating bananas anymore. It just doesn't make sense. You've got to look at a good long-term buy and hold type scenario. And what we're looking at, 2 key trends set to define 2022. And this is coming back here, and I'm going to put them both up at the same time here. Both of these are nationwide. They're across borders. but it's an affordability boom. So yes, we're going to see median house prices pull back a little bit, definitely in Sydney and Melbourne, and definitely whether they'll actually pull back in Perth, Brisbane and Adelaide, I'm not sure, but I think they're more likely to hold. Definitely the growth might slow a little bit, but that's because more of higher priced property and medium priced property. But affordable property, sub $1 million, there's still going to be a lot of pressure in our view on the market. And there's also a nationwide rental crisis, and it's not going to abate anytime soon. In fact, we think it's going to get worse over the next 24 months. So you really want to be a landlord. You don't really want to be a tenant. What happens in a 5% interest rate environment? So you might kind of go, oh, geez, is the market going to crash? There's talk of 25% and this and that. Again, most of the predictions that have been made never come true. And it's not like the share market. So I think, again, and there's not one market, I think you'll find that really good quality, affordable properties, close to amenity, everything else, even if there is any price correction, it's only going to be a minor correction. But there will be some parts that have gone too far, or certainly a little bit more so in Melbourne and Sydney, and particularly in those medium to higher price things where things will pull back significantly. But look, we think the market will adjust. 5% interest rates, when I started investing, interest rates were 7.5%, 8%. That was normal. So for me, even 5% is just, wow, that's amazing. There's still going to be incredible competition for affordable property. And the reality is that property is still very easy to hold with rising rents, depreciation on particularly new property, and the interest is tax deductible for investors. Now, I wanted to just give you all a little gem, I suppose, of 4 ways you can boost your portfolio's cash flow. So some of you watching this may already be investors and have properties, and others of you may not have investment properties. So depending on what position you're in, what you really want to do, the first couple are really for people that already have properties, and then the other ones are for people that don't have properties yet. But 4 ways to boost your portfolio's cash flow, because cash flow is king and only going to become more so as we move on to. So the first one is interest-only loans. Interest-only loans sort of went out of vogue a little bit. Obviously, there was monetary controls that were brought in by APRA, making interest-only loans, trying to discourage people from them to make all the loan books safer. But the reality is, for an investor, interest only makes sense, and it's going to help your cash flow a lot. So rather than having everything principal and interest, to get a little bit of a discounted loan, what you're going to find is people would rather pay a little bit more, say 0.5% or 0.6% more, but than a P&I loan. But the reality is that all of the interest is taxed up when it's going to help people's cash flow, so you've got more flexibility and can use that money to take advantage of the economic climate that we're in. The second piece of advice there, because you'll be able to buy more properties and have more borrowing capacity interest only. The second one is ride the tide. We're in a rising rent market, and our prediction is that rents are going to go up at least another 10% this year in 2022. So again, interest rates, yes, they're going up a little bit. You can go interest only, and then you're going to be able to have the benefit of some rental increase as well. Now, the next things apply to all of those things apply to all properties. But now, what if you don't have properties yet and you're thinking about where should I invest? Well, what you want to is you need to make sure that the yield, that the rental return is as high as possible. So target high current rental yield. So you're looking for locations and types of property with strong rental demand, and obviously having people or a company or people around you who can help you locate those properties is going to be incredibly important. So you want the highest yield possible. And the final one is targeting new property, high depreciation. So depreciation is a whole bunch of tax deductions that you can claim on a property over the period that you have it. Now, they're different for existing property versus new property. And Malcolm Turnbull changed the rules back in 2017 to make the differences even greater between new property and existing property, where a whole lot of deductions that are available on the plant and equipment, all the things that are inside a property, not the structural things, that those things now can only be claimed on an ongoing basis by the original or first owner of that property. So again, thousands of dollars more back in tax. So new property makes sense, and you really want to sit down and do a cash flow and understand how it all works. So look, on that note, just to sort of bring things to a close, we talked a little bit about the market. We talked a little bit about the importance of diversity and those sorts of things. And so Ironfish, what we do is we help people actually go about this, because most of our customers, they're busy people. They've got lives. They want to have a team of people around them that can really help. And what we try to help people to do is to actually implement, put in place what we call our portfolio approach. So you can see there, the idea is minimum of 4 properties. There's a plus sign. Why stop at 4? 4 properties over a minimum 10-year period. It really should be 15. So you need that long-term focus. And then the portfolio itself, you need diversity, different types of properties. That's why there's a 2+ there, and different cities. Don't have all your eggs in one basket. And how do you do that without flying around the country and all the rest of it? We have local offices on the ground in each of the markets that we represent. We've been around for a long time. Almost 90% of all Ironfish staff are investors themselves too. I'm a customer of our company, and look, as you can tell, most of our staff are as well too. So look, it's a pretty compelling opportunity, but you've got to find some way for yourself to have a team. Doesn't matter who's on your team, but there's no way after running your own business and everything, you're going to have the time and necessarily to do that. And that's probably what I recommend, is that you make a chance. I'll show you a slide at the end where it gives you the opportunity to download that free ebook and potentially to sit down with one of our strategists. But I want to talk about business owners, because even though I've been talking about the property market and all sorts of things, there are fantastic opportunities around Australia at the moment, and there will continue to be. Don't believe all the hype in the media. Remember, there's not one property market with a big brush, all right? There's a whole range of things. But there's 3 reasons, I believe, why most business owners often don't invest, I think, enough in property, all right? The first one is that as a natural thing, you're thinking about cash flow as a business owner all the time. And what you tend to do is pump it back into the business. And that thing of pumping it in, that grows bigger and bigger and bigger, you've got to find ways to not have all your eggs in the one basket. And that's kind of, it's a very addictive and very natural mindset and process of thinking for someone to do that. But it's really, really dangerous. You've got to find a way to get some of that money and make sure that it's not all going just onto your business, no matter how good it is, all right? Because things can change in business. The second one, they haven't set the business up to be able to invest. Classic one with this is someone sets them up paying themselves a very low salary, again, not taking enough out of the business, and they think they've got a business. What you need to do is set the business up so that you can take a decent salary and then find legal ways through tax deductions, various other things, to minimise your tax. But you've got to set yourself up and set the business up to invest. It might be that the business buys the properties and you're not yourself personally as well. There's all sorts of structural things that you can do, but you've got to set yourself up with the right structure. And the final one, and I think this is really the important one for most people, is that we all lack time, all right? And we all have this DIY attitude and mindset in Australia. What we need to realise, though, is that what that results in is it results in a lack of results outside of it, right? If we don't have people of specialists around us to support us doing anything, then we're in big trouble. And so on that note, just to bring it all to a close, Ian, I would like to just offer you all, you can see there's a QR code on the screen there. If you hover your phone over that, etc., or you can just go to our website, ironfish.com.au. But when you book a discovery session with one of our experienced strategists, what you can do is we'll send you a copy of this Hottest Markets Right Now ebook. And it's a fantastic read. It'll obviously give you insights into different places around Australia. But I would recommend, whatever you do, don't just assume and read all the headlines and everything, because we're all receiving a bit of a barrage at the moment of negativity. The stock market is absolutely tanking at the moment. We can see it probably continuing to do that. The property market is not quite the same as the stock market, everybody. And certainly one of the best asset classes you can be in an inflationary environment, often real estate can be the way to go. So there we go, Eeyore.
Grant, thank you so much.
For everyone, and a great way, hopefully, to start off a great day.
That was fantastic. Some great insights there, and I'm pretty sure a lot of people that attended this got a lot of golden nuggets from it is what I call it all the time. But thank you so much, Grant, for your time. Really appreciate it. And more importantly, we'll definitely send that link to everyone. Everything is recorded here as well, so we're going to definitely distribute it everywhere. That's for sure. Thank you so much, Grant.